Good morning, friends. Good morning, Dr. Joseph.
Good morning, Vivek.
So, Doc, welcome. It's always a pleasure to have a conversation with you.
Thank you.
On the markets and the current and various other topics.
Thank you.
Related to the markets as well. So, today our topic of discussion will cover the biggest dilemma today the investors face in the current markets. I think markets have fallen more than 15 to 17% from the top, and still even in spite of this kind of a fall, still there are question marks as what will happen or what could happen at the current juncture. So let me start the conversation with a couple of questions. So right now, fundamentally, what should the investors do at present? Is it comforting right now to invest, or they should kind of wait it out?
Yeah, Vivek, there is no room for dilemma as such. I would like to call it Hobson's choice. It's mainly because over longer time periods, say medium to long term, maybe over a period of say 5 years or 10 years, the markets have to align themselves with economic fundamentals. So if we look at the economic fundamentals today, as far as Indian economy is concerned, if you look at the GDP growth, we had seen it declining to 5.4% in Q2, but in Q3 it has come back again to 6.2%. And we believe that structurally we are tuned to grow at around 7%. So growth has come back. And if you're looking at the recent manufacturing and industry numbers, growth is coming back from the Q2 decline that we had seen. So fundamentally growth is there. And what is more important for the markets is that earnings growth and corporate profitability is actually positively correlated to GDP growth. It's a function of GDP growth. So we can draw immense amount of comfort from that. A second thing that we should be looking at is that we had the budget and the monetary policy. It was not very far in the past that we had both these announcements. And so the fiscal policy as well as the monetary policy are very well supportive of growth in the economy and also in supporting the system. We expect the RBI to cut rates. RBI is adding sufficient liquidity into the system. Therefore, there will be cheaper credit. There is no better factor that could propel markets higher than liquidity and interest rates, which are conducive to growth. On the fiscal front, even from the perspective of external investors, the fiscal glide path is very clear now, and we are adhering to the fiscal deficit targets that we have set for ourselves. It's a great positive for overseas investors and also for domestic investors. The public capex, which was lagging for some time, up to 31st of December, I think the spend out of public capex was only 45 to 50%. And the finance minister herself had said that by March 31st or so, we'll be at around 90%, 91% of public capex. The same order of public capex is going to happen in the next financial year also. It's already provisioned in the budget. So these are all some of the fundamental factors which are likely to give a lot of strength to the economy, and therefore the markets would also do very well. So if you're looking at the fundamentals and a final alignment of the markets with economic fundamentals and economic realities, there is only one choice. There is no choice at all. You need to invest today, especially when conditions have become much better in terms of price and valuations. So one should invest today. That is the only choice left.
So when you said price and valuations, so what are the valuations looking like right now? Yeah. You can probably decipher it in market cap, various market caps, across market caps as well. And is it comfortable to invest right now, fundamentally, valuation wise?
Yeah. When we look at individual market cap valuations, we can very comfortably say that the large caps have become quite attractive, and it is a segment where investments should be made in, because it is from large caps that the FIIs exited most. They have been liquidating mostly in have been liquidating mostly in the large caps, and that was where most of their funds were earlier. But it is also a fact that if you look at the last 3-4 months when they have been exiting, they have in fact made some investments into small caps and mid caps. And they haven't taken out money out of small caps and mid caps, but they have been taking it out of large caps. So large cap valuations look very much close to, at this point of time, towards the last 5-year or 10-year average valuations, which is like 19.60 to around 20.30. That is the kind of valuations where it is at this point of time. So it's close to the long-term averages, and therefore it makes the segment attractive. When it comes to mid caps and small caps, the valuations had stretched beyond all imaginations, mainly because of the flow of funds into these two market caps, mainly through the SIP route in mutual funds. A lot of liquidity had moved into mid caps and small caps. Mid cap valuations have come down from around, it was at around 33, 36 ranges to around 26, 27 at the point of time. Based on long-term averages, the valuations, there is still a gap, because reasonable valuations would look like something in the range of 19 to 24, whereas right now it's at around 26, 27, but the gap is very small. In the case of mid caps also, the valuations look slightly more expensive compared to either large caps or mid caps. But at any point of time, there will be a preference for mid caps or small caps, even for domestic investors and for overseas investors, because of two fundamental factors. Because the rate of growth, the business revenues and sales, and the rate of growth which mid caps and small caps would register and have always registered has been of the highest order compared to even the large caps. Second is that in mid caps and small caps, the market capitalization has expanded substantially. Today, any stock which has a market cap up to 33,000 crores is a small cap. Anything up to 99,000 crores is a mid cap. That's the classification that we follow at this point of time. So market capitalizations have expanded. So because market capitalizations have expanded, it will be easier for overseas investors who usually come in with larger amounts to put money into these segments, because market caps are larger. Therefore, they can bring in 5,000 crores and then put it in a few stocks. They have greater comfort because of the larger market capitalization. Earlier, we used to see 750 crores or 1,700 crores kinds of market caps. So therefore, the large caps do make immense sense in terms of investments for a part of the portfolio, but we should not lose sight of the growth and therefore price performance which mid caps and small caps will offer in the coming years. There is immense amount of steam, and not only that, at the end of the day, it's from the mid caps and the small caps that companies graduate into mid caps and then into large caps. So in terms of growth and price performance, and in terms of the liquidity and the market cap it offers at this point of time, giving comfort even to overseas investors, we should be positioned appropriately in mid caps and small caps to maybe a smaller extent, to take advantage of the fall in the markets, relatively attractive valuations which are also available at this point of time, against the context of growth picking up and moving forward.
Got it. Interesting. So across market caps, I think large cap look much better.
Yeah.
Okay, got it. Now the biggest topic of discussion, I think geopolitics today is, and everywhere world over, I think there is a clear tariff war which has started. Now, do you see more disruption that this tariff war may bring in? Or maybe it is kind of short-lived once it's kind of implemented fully. How do you see that playing out?
Yep. As far as tariffs go, in practical terms, it will have only a one-time effect. Tariffs, once they are established, and it goes on for years and years, and it will have only one-time effect. Now, coming to the US, which is now the source of this tariff war and the turbulence resulting from there, the US is a net importer of goods and services from so many countries, including Canada, Mexico, China, India, and all that. So, those countries enjoy a positive trade surplus with the US. Therefore, the US is a net importer of goods, whether it's fruits and vegetables, milk products, whatever it is, and therefore, any tariff walls which others would place, any tariff walls which other countries would place, or any countervailing tariffs which other countries put, will be to the disadvantage of the US, because they are net importers. But at the same time, it will become slightly difficult for other countries to gain entry into the US, maybe because the tariffs would make their goods slightly more expensive. But it is more of a problem. If countervailing tariffs come up, it will be more of a problem for the US rather than any other country.
Would it be inflationary?
It will be inflationary to some extent. It is because the food and fuel component of the US CPI is around 18.5 or 19%, assuming that it's around 20% food and
18% of
food
the
and
overall CPI.
And actually, it is food items which will get affected more. Energy, of course, will be there, fuel and all that, because they still get electricity from Ontario in Canada. But the impact will be more on these fruits and vegetables and food items, and to some extent in energy, which has a much lower weightage in the consumer price index, whereas housing and healthcare and education have a much higher weightage in the US CPI. Therefore, if you are looking at the CPI for the impact of the tariffs, it may not be very highly visible, like it is visible with maybe healthcare or school education, etc. It may not be as much visible, but there will be some impact.
That is on the 18% of the...
That is on that 1/5 of the CPI weightage.
Index.
Now, as far as the US CPI is concerned, the latest data which we got yesterday puts the headline CPI at around 2.8%, and the core CPI is at 3%. So inflation has already moved down a little bit from the earlier 3.1% to around 2.8%. That the CPI has moved down. Core inflation also has come down. So it gives some comfort that if the next number is to come slightly higher, it will be moving up from 2.8 to maybe 3.1 or 3.3. So it will be inflationary. It will have some impact, but it will not be that visible because of the smaller percentage of weightage as far as this food, fuel, and all that is concerned. So a second thing is that countries like China may be more aggressive in combating the US tariffs. Okay. Last time also that was what happened. Yeah. So China could reciprocate and put higher countervailing tariffs. Yeah. There have been also reports that China could, in fact, devalue its currency, because one of the means by which the import tariffs could be countered is by putting letting the currency weaken further from the current levels.
That is a weapon that China always has.
Yes. Last time also, when China did more or less the same thing like the devaluation, a lot of overseas investors moved out of China. Correct. So they would be probably more careful this time. But the likelihood of China going in for some currency measures to counter this is highly likely. That's another. Coming to India, India is already negotiating a multi-sector bilateral trade agreement with the US. This agreement for a multi-sectoral bilateral trade agreement was reached when Prime Minister Mr. Modi visited the US and met up with President Trump and the other officials. There was an agreement that they will go in for a multi-sectoral bilateral trade agreement. So now, after Mr. Modi went and came back, there has been a delegation headed by the Commerce Minister, which spent 2-3 days with the commerce and trade officials in the US, negotiating further on what needs to be done on different counts, because it's not a very simple thing. It's a very complex thing covering thousands and thousands of commodities and export and import items and all that. So that is being worked out. So there is immense amount of clarity as far as India is concerned on what needs to be done. And we are open to reducing, hiking, the way we could work better with the US. I think we'll be open to that, and therefore we do not expect any aggressive tariff hikes from the US on that front. At least for the coming 1 or 2 months, we may not expect anything, because discussions on the multi-sectoral bilateral trade agreement is on.
Okay.
That is, therefore, we do not envisage any immediate impact on the economy on account of the tariffs. Plus, the US itself is most probably going to renegotiate a lot of things with Mexico, Canada, and also the European Union.
Okay, interesting.
Yeah.
So I think that is where I would say that India will not have that much of an impact for the tariff.
Because these negotiations are in progress, and I think that should prevent the other party from putting any
tariff.
major tariff actions at this point of time.
Okay, got it. So another, when you say China, another related topic is, well, when will the FIs return? And will they return to China or India? What do you feel?
FIIs, one of the global surveys had put Japan and Taiwan as probably attractive destinations for the FIIs. In terms of valuations, the Chinese market always looked good, with the PE around 13.5 to 14, compared to our large cap PE at around 20 and a half. So what happens is that, but that's not the factor which FIIs go by when they make investments. They did put in some money into the stock market in China, but it was not very substantial as such. There was flow into Japan and Taiwan. Japan mainly because growth has picked up in Japan. After 3 decades of sluggishness, growth has come back into the Japanese economy. Rates are rising. They expect corporations to do better. Earnings growth will be much better. There is growth actually happening in Japan, so it's a positive thing. Therefore, they have been putting money into these countries, and we expect FIIs to come back to India, mainly because of the rate of economic growth. Second, there is greater certainty about the currency. India is not going to devalue its currency. India has let the market forces determine its currency value. Therefore, we are more flexible on that count. We may not devalue our currency. We are a more orderly system and a society. One of the fundamental factors that should go into support FIIs moving into India is a further cut in US interest rates. If Fed has so far cut the US Fed funds rate by 1%, and Emkay Wealth view is that Fed will cut the Fed funds rate by another 1% during the course of this calendar year. Because Fed hiked the Fed funds rate by 5%. 5%. From 0.25 to 0.5% to 5.25 to 5.5%. 5% it was hiked. So we believe that in this initial part of rate cuts, it should be at least 2%, where it should settle down before it could either stabilize there or it could go down further. There have been some talks of the Fed postponing the next rate cut to the next year also. by a large number of analysts and economists. But our view is that another 1% rate cut is possible and highly probable for during the rest of this calendar year. Mainly because US inflation is much lower today, 2.8% and core inflation at 3%, which is very close to Fed's target rate. Number two, there is a talk of US recession now.
Yeah, that's another topic.
Either because of the tariffs or even otherwise.
The hard landing, soft landing, whatever.
Sequentially, US GDP growth has been slowing down. Quarter on quarter, US GDP growth has been slowing down. And that should also, and unemployment rate is not at the lowest levels. It has moved up. And it is likely to move up because there has been some measures from the government itself. Sending a lot of federal employees back home. Right. So these things are also going to have some impact on the economy, and the rate of economic growth could stay sluggish, even at least for the next 1 or 2 quarters. That's our view. And if that's the economic reality, that inflation is coming down, it has already come down. Fuel prices are within control in the sense that, in fact, they have a downward bias now, soft bias now. They may be in a range of, say, Brent has moved below 70, but the broad range we have forecast is $70 to $75 per barrel. So it should move up and maybe within the $70, $75 per barrel level. So inflation is southbound. And growth is, there is a sacrifice of growth that has happened because of the rate hikes. Unemployment levels are slightly
because
higher.
The government, federal government moves
and all these things. So all these things would point towards the potential for further rate cuts in the US. And once rate cuts happen, monies which generally chase high risk, high return investments move into the emerging markets. We expect that phenomenon to happen over the next 1 or 2 quarters. It will take for FIs to come back. Though our dependence on FI money is not too much, if they come in, it's well and good. The more, the merrier. The domestic investors themselves put in. Even as of today, it is the last month's numbers is 25,999 crores.
That's the SIP.
As against SIP numbers, 26,400 the month before that. So which means that domestic money is already flowing in plenty.
That's the support, that liquidity support.
Liquidity support which the domestic markets are getting. So these are all some of the factors which should give us the confidence that this is the time to move into the markets and start investing. It could be even in an SIP mode. You could start investing, but you should not miss this opportunity. Going by longer term cyclical movements and all that, some of the analysis which I happen to go through says that the worst fall from the current levels for the markets. What is the fall that we had seen a big fall as the pandemic started, and before that also a couple of times. When you look at some of those falls and also cyclical fall in the markets, after the current fall in the markets, there is very little room for the markets to go down. The room for markets to go down would be something like 5% to 7% maximum. Okay. This is borne out by statistics and numbers. So 5 to 7% is the worst fall from the current after the current correction, which is very nominal or which is very small after such a big fall. And one should not be on the horns of a dilemma whether to invest or not to invest, because the probability of the market moving higher from the current levels is very high. And the probability probability of it going down by maybe another 5% or 7% is very low. Therefore, the only choice before us is that we should start investing today, but for the longer haul.
Staggered
for the longer haul.
Yeah, so the downside is limited essentially.
It's very limited.
And upside is where it could kind of catch up by the moves that you're saying.
Yeah.
So coming back to US, I think you see a soft landing. You don't see a recession as such?
No, I don't think so, because these tariff-related things will get sorted out over the next few months. Except for China, I think it will get sorted out mostly. But Canada is equally important because
It's a major trade partner.
Yes, it's almost $100 billion of net surplus which Canada enjoys in all these fruits, vegetables, poultry, and things like that. So Canada's stance in countervailing tariffs was more aggressive compared to any other country, because they said that we are your neighbors, we are on the same continent, we have been always gentlemen, so we should talk these things out rather than handing out threats. So they have been more aggressive in facing the U.S. Tariffs. The response has been more aggressive. So over the next 2-3 months, I think it should settle down.
Got it.
That is what we feel, and there will be more clarity. But with China, it could go on for a long time, because during Trump's term last time, the tariff war with China was one of the things which was causing some amount of turbulence. So China thing would take a little more time to resolve. This is what we feel.
So essentially there could be a slowdown, but you don't see a recession as
there is
such.
a sluggishness which has already set in.
So there
and
could be
it could continue like that. Usually if a sluggishness comes in and some immediate measures are taken, over 2 quarters or max 3 quarters, growth could pick up. We have seen our Q2 GDP at 5.4. Now it is back again at around 6.2. In our case, it's picking up very fast over 2-3 or 1 quarter, 1.5 quarter. It is picking up.
So there are signs of revival.
There are signs of revival.
So good. So there are signs of revival, as Doc is saying, and I think recession is by definition, just for our investors, is basically 2 quarters of negative growth. So don't see that happening. There could be some short-term sluggishness, so that in itself will come back. So coming back to India, Doc, is the long-term story still intact?
It is completely intact, because the fundamentals that influence the markets are intact. The fundamental is growth, GDP growth, which will target, say, something like 6.8 to 7%. Liquidity and interest rates. We have plenty of liquidity being injected into the interbank market by the Reserve Bank of India. Interest rates will be much lower than what we are seeing today. It has to come down. The public capex, that will also add fuel to the engine for it to work better, because it will benefit a lot of companies, a lot of downstream companies, a lot of public sector enterprises, including HALs and many other power companies. Then the domestic liquidity conditions of retail investors becoming part of the whole movement is a very positive thing, and it still stays at 26,000 crores on a monthly basis, and that is the trend in the last 2-3 months. It's almost there, maybe 300-400 crores this way or that way, but it's maintaining an even level. And likelihood of FI is coming back with US Fed rates coming down. And we have very healthy political and economic conditions.
Stable political environment.
Yes. And I think we will manage, because even the tariffs and the countervailing tariffs have a political angle and also an economic angle.
Economic angle, correct.
And I think India has already done 2 interfaces with the US. Once during Mr. Modi's visit, and once in the first week of March. 2 interfaces in a fairly detailed way on the tariffs. So the political aspect of it and the economic aspect of it is being managed properly.
And so, even the FTA that they are working on with the Europe.
Yeah,
So I think
Europe and the EU and the
EU
and also the UK.
Yeah.
I think we are moving in the right direction.
Directionally we are right.
Yes. So all these things are positive for the economy and the country. We are a growing economy.
Got it. So now coming back to the yields, market yields, when we are talking about rate cuts happening across the board.
Yeah.
And along with that, we have a situation like a tariff happening, which is slightly inflationary, at least in the short term. So will the yields still stay high up, in spite of the rate cuts? How do you kind of see that? What would be the impact of tariffs on that?
Yeah. See, the yields moved down. Say, for example, the 10-year benchmark yield moved down to 6.60, 6.63, 6.4 levels.
Yeah.
And it retraced back to around 668, 670 levels. So it hasn't traded out of this range, except for 675 occasionally. It hasn't traded out of this range. And the bias still continues to be one of lower rates. Okay. But the last rate cut from the RBI, which was just 0.25%, disappointed the markets and a lot of market participants to a large extent, because many people expected a 0.5% rate cut. Because many felt that that was warranted, especially against the slowdown in GDP growth to 5.4%. And also there was nothing much that was happening in consumer demand and also in consumer demand and also in terms of private capital investment. But now things have changed. There will be more money in the hands of the people because of the 1 lakh crores odd of money which the finance ministry is going to put into the pockets of individual customers. So that should also give a further boost to the economy. But what we are seeing is that the 0.25% rate cut last time is just the beginning of a series of rate cuts. And the 0.25% cut was a signal that we stand in readiness to cut rates. And if required further, we will cut rates. And the governor himself said that the space for rate action, because of the changing inflation growth dynamics, the space for rate action has improved or it has increased. That was what he said, which means that there will be further rate action and rates will come down.
Okay.
The 10-year benchmark remained more or less at the same levels because there was some selling by FIIs of the benchmark, which they had picked up, they sold. So the benchmark yield was under some pressure because of the selling, though it didn't move out of the ranges. The second thing is that we need to get further rate cuts from the RBI. Once there are further rate cuts from the RBI, which I think would be, the rate cut so far is only 25 basis points on the repo rate. There will be another 75 basis points that we are expecting during the course of this calendar year. Okay. There will be further rate cut to the tune of about 75 basis points.
This calendar year.
This calendar year.
So December 25, you are expecting another 75 basis.
Yes, by around 1%, RBI would have cut the repo rate by December 31st, 2025. So that is a good situation. Second is that the government borrowing program is higher, but higher only by a very nominal 5%, and that too on the gross borrowings.
Okay.
And the net borrowings is higher only by 11,000 crores, which is a very small amount, negligible amount. From the point of view of a very large government borrowing program, 11,000 crores net borrowing increase is ignorable, eminently ignorable. So there is no large government borrowing program which is going to disrupt the markets. There was lack of liquidity deficit in the interbank markets, which had mounted to the tune of about 4.5 lakh crores. RBI has very efficiently added liquidity into the system. And it was very nice to see that RBI employed almost all means of liquidity addition, starting with the CRR cut, open market operations and sales of buying of securities, variable rate repos, the long-term dollar-rupee swap. So they employed all these instruments to add liquidity into the system, and I think they will continue to do that and to maintain smooth conditions in the money markets. Therefore, from the current 6.69, 6.70 levels, if we are talking in terms of the current 10-year benchmark, we expect the first target for the yields to be around 6.60, 6.60%, and a subsequent target would be something like 6.30 or 6.35% would be the second target once we go in for further rate cuts. So we need to have more definitive stance from the RBI in terms of fairly larger rate cuts coming through in the coming months. Then only the yields would move down, and then gilt funds
Would
and
become
the bond
attractive.
funds and all that would become attractive. Otherwise, gilt funds and bond funds are giving something like 6.5% or 7% at best.
7%.
So it has been near around that level only, which is more or less what you are getting from a liquid fund or an overnight or ultra short-term fund. So, but those people whose risk profile would permit investments into gilt funds should invest and also stay invested, because this view is valid for a period of 12 to 18 months and not for 2-3 months or 5-6 months. It will pan out only over a period of time as RBI policy gets into a now series of rate cuts. And the impact of those rate cuts do get transmitted to lower levels. The transmission has to happen through liquidity. So we are positive on gilts and gilt funds and all that.
So duration as a play stays.
It still stays, and those whose risk profile would permit that, because it's also an avenue where there will be some amount of volatility.
Correct.
Rates could move up and down.
Short term, there could be some.
As against movements in the US markets, the rest of the world, and also domestic markets, there could be some amount of volatility, and if those who do not like volatility or waiting for a 12 to 18 months time period should avoid it. Otherwise, it's an avenue where you can put your money and then wait for the next 1.5-2 years to get good returns.
So slightly longer term, you could play duration, and you should play duration. You could reach double-digit returns once the transmission happens.
Yes.
And RBI essentially, to what Doc is saying, to sum it up, RBI essentially is in alignment with the government and focusing on growth as well.
Yes.
I think that in itself is a trigger that, rates will kind of come down.
Yeah.
One last question, Doc. Fresh allocations.
Yeah.
In today's market.
Yeah.
How would you look at it from an equity perspective and from a debt perspective, both?
Yeah, from an equity perspective, fresh allocations, I would say that you should allocate to good managed funds. And in managed funds, if you are looking at equity funds, two segments or segments which we have been recommending quite aggressively are infrastructure and PSU equity funds, infrastructure funds and PSU equity funds. These are two avenues where one should invest and continue to invest. In terms of positioning market cap wise, one should be looking at large and mid cap as a segment one should be investing into, and then small caps. Small caps could be maybe of a small portion of the total portfolio. If you're looking at the entire allocation, the small cap allocation could be something like 15 to 20%.
15%.
And the rest of it could be into large cap and mid caps.
Large cap will be higher.
Yeah, large cap will be higher, and mid caps followed by mid caps. But mid caps would be the segment that will give you higher growth and therefore higher price performance, and
higher alpha will be
there. That could broadly be the way it could be allocated.
The equity portion.
Yeah, the equity portion, and it is also say people investors who have a rather moderately aggressive positioning.
Balanced.
You could look at the balanced advantage funds, which would also give you very good returns over a fairly longer time periods. So balanced advantage funds could also be, because we have given a lot of importance to balanced advantage funds in our recommendations, along with the infrastructure funds and the PSU equity funds.
Got it.
At the same time, when you are allocating large and mid cap, there should be some amount of allocation to value funds as well.
Okay.
Very good value funds.
With the fundamentals now looking better.
It's much better. The portfolio valuations looking much better. This is the time actually to start investing and not be in a dilemma, but invest.
In value themes as well.
Yes. That is broadly the positioning. As far as debt goes,
on the debt side, yeah.
On the debt goes, because even corporate bond portfolios and short-term instruments which carry higher portfolio yields like 7.5% to 8% or closer to 8% could be looked at with as far as short-term to medium-term investments are concerned. For fairly longer-term investments, one could be looking at direct exposure to even PSU bonds or private sector instruments and NCDs and also gilt funds.
So the question would be larger portion depending on the risk. If the risk profile is higher, then you could have more duration, less accruals.
Yes. Say in a portfolio of say 100 rupees, the long end of the curve, you may have an allocation of maybe to 30 or 40.
Okay.
The rest of it could be, because in any portfolios which have a orientation towards debt may have an orientation towards liquidity availability also.
Correct.
When it comes to corporates or
Requirements.
trusts or even.
Requirements.
So maybe 10%, 15, 20% could be in easy liquidity, like liquid, overnights.
Short term and overnights.
Yeah. In that also you have some funds, money market alpha funds and all that. I wouldn't like to name any specific funds here, who may have a larger portfolio yield, but which may be picking up instruments up to around A- or A+, and which will carry a higher portfolio yield from which investors could gain from. But there we need to be very mindful of the kind of credit risk that we may be taking. But it will be very negligible given the fact that those instruments may be of maturity profile of maybe 100 days, 150 days. So these are very short-term instruments.
So the risk gets reduced.
Yeah, it gets reduced. So these are some of the instruments which corporate bond funds could be invested in.
Corporate bond.
Those portfolios also carry much higher yields like 780, 760, 780% levels. And finally, maybe to the tune of about 25-30% or maximum 40% gilt funds could be looked at. That is how it should be broadly allocated.
Got it. So majority should be maybe a 50-50 and a 20% in terms of favoring the liquidity requirements of the corporate.
Yes.
Thanks a lot, Doctor, for your views.
Thank you very much.
And I hope that, the dilemma is now slightly reduced and we are positive basically on the current market scenario. The only way that an investor can beat this kind of volatile times is by staggering it, or the classical way of SIPs. I think fundamentally, to sum it up, as Doc said, we are looking quite attractive on the equity side across market caps. So I think slowly but steadily, definitely look at investing, and to start with, probably the larger companies, and then build a portfolio downwards. Thanks a lot for your time. Thanks a lot, Doc.
Thanks, Vivek. Thank you very much.